Well, welcome everyone to Resource Roundtable. Resource Roundtable is an ongoing event every third Thursday of the month, hosted by EDC Team Jefferson. And it's a place where we invite one or more guests to come and introduce themselves and their services to the people of Jefferson County.
Today's presentation is about business valuations, and for various purposes, you may want to know how much your business is worth. Businesses have two values. And you may hear other people say there are more than that, like common size or triple the net, and that doesn't really conform to financial theory. In financial theory, there really are only two values, the liquidation value and the discounted cash flow value. Now, if we look at the liquidation value, it's very simple. It's you sell all the assets, pay off the debts, and what's left is the liquidation value of the business. It's usually the lowest value for a business that has profits. But a business with no profits, the only value is the liquidation value. So the first thing to do is to determine what the profits are and what you're going to pay for them. So if we first of all think of a savings account, this will help you get your mind wrapped around what we're trying to do here. So if now you have $100 and you invest it at 6% and want to pick it up in a year, you should be able to pick up $106. Likewise, if you have another $100 invested at 6% for 2 years, it might not be exactly 112. It might be slightly more than that because there's interest on the interest. So you go for a year and you pick up 106. That's still invested, so you might pick up 112, 13, 14. Also, on say a third $100 at 6% for 3 years, you're earning interest on the interest for actually 3 years. So it's $119. And I'm going to stop and just make sure that everybody understands that calculation. Is there any question about the fact that you invest something and the longer it's invested, the more it's worth? Okay. Now I'm going to show you this same graph, but I'm going to reverse the arrows. And we're going to name these things slightly differently. So the year now represents what you want to pay for future profit. So if you go down under year, it says profit, and under 1, 2, 3, you see the profit out there in the future is 106, 112, 119. And what you have to decide is what you're going to pay for each of those cash flows out into the future. And just like a savings account, if you reverse this and you take $106 and you discount it, that's what it's called, discount it backwards 1 year, you would pay $100 for that 106 and make 6% on it. Likewise, if you went out 2 years and said there's 112 or 13 out there, and you discounted it backwards 2 years, you'd get 100. And likewise for the third year, the 119 discounted backwards 3 years and times is worth 100. When you add up all of those values, that is the discounted cash flow value. Now there are some nuances here about this, and that is that you typically use 10 years worth of future profits. And the discount rate is not going to be 6%. It's going to be representative of the risk. So what is a 6% risk? Well, right now, that's about a pretty good CD that you could buy at the bank with no risk at all. The stock market can return you 10 to 11% over, say, a 30-year period with ups and downs. And so that's the risk of the stock market, 10 to 11%. But you're in small business, and so it's riskier than that. So it might be 12%, or if you perceive even more risk, you might say 14%. But you can see that if we, the more that we want out of it, the higher the risk rate, the discount rate, the smaller these numbers are going to be. And so I'm going to show you an actual example. Oops, I'm going to have to share my screen again here. Hold on. Share my screen. And this is an actual example of a discounted cash flow. And you can see on line 10 there that we have these mini profit and loss statements going out into the future. And you can see the numbers in blue, like the projected profit margin for this business is 10%. You can see that on line 13, the projected rate of expansion of revenue is 4.17%, and then at year 4 it drops down to 3%. But where do those numbers come from? So let's go down and find out where they come from. So down here in the analysis part, what we're looking at is to build a profit and loss statement there on the left that has $10,000 in revenue, and you can see down below it's operating expenses of $8,000. But we have to adjust that to make sure we understand what the real cash flows are. So we've determined that, and adjustments are in this middle column. So you can see that the income has not been adjusted, that the cost of goods sold has not been adjusted. But here, like this might be a $8,000 expense for your personal apartment in Seattle, and plus other expenses. And what we're saying is, no, we have to take out that $2,000 that you're paying personal expenses out of the profits to reduce that expense to $6,000. So you can see then down here that if we had looked at the left-hand column, this business would have no net income, or a negative $1,000. But when we adjust it for the true cash flows of the business, it actually has a $1,000 profit margin. Now, any questions about the fact that we have to adjust the profit and loss statement from the business to take out expenses that are not business expenses? Any question about that? Okay.
I would just like to say something about that.
Yeah.
I'm going to stay with my video off because I'm sick today and I don't feel very pleasant to look at.
Mm-hmm.
I think the thing to remember is that often as a business owner, we're writing stuff off. And that's, one of our advantages is that we can pay less tax because a lot of stuff is legit to write off, but sometimes stuff gets mixed in that shouldn't be. And then that's what these add backs are.
Yeah, add backs or deductions. Yeah.
Yeah.
In this case, we've taken out part of that expense to increase the profit, to show what the real profit of the business is. But you might also say, well, they could be the reverse. We could be adding expenses that somehow we've left off.
So I think there's two ways that businesses can work against themselves. And one is to take a tax avoidance strategy in terms of creating profit. And the other is to write off like way too much if you're seeking to sell your business soon, because it makes your business look like it's not creating much revenue.
Yes, and anybody who's going to create a discounted cash flow analysis is going to want your tax returns. And if you have been dishonest on your tax returns and said that there are low profits, well, you can't really talk your way out of that because the buyer is going to say, well, that's what you reported, and why should I believe that there are any more profits than what you've reported? So you do yourself a disservice by showing low profits on your taxes when you're going to sell the business.
So how far ahead should people plan if they're going to sell their business in terms of, being willing to perhaps to pay more tax or, to show more revenue?
Well, I would say right now, immediately. It's my opinion that, and what I do in counseling is try to help people create the maximum profits, and they can easily pay their taxes, but they walk away with more cash because they run more efficient businesses. But I would rather have 10 years of great profits when I come up to selling the business than just the last year because I started telling the truth on my tax forms. I would like to show the history, and that's the next part of this analysis, unless there are more questions.
I have a question, Douglas.
Yes.
So the $2,000 represents the apartment in Seattle,
Right?
not $8,000.
No.
Just 2,000 of the 8,000.
Right.
Gotcha. Okay.
Okay. Any other questions before we take another leap forward here? Okay. So we take this profit and loss statement. It's in column D, and here's the mini version of it over in column F right here. Okay. That's the same thing, but just a mini version of it. And we come up with a, here's the profit margin of 10%. That's $1,000 divided by the $10,000. But we also want to know what the rate of expansion is. So up here, here's where your previous profit and loss statements confirmed by your tax statements would show your net cash inflows or income. And in this business, it's quite regular. And that amounts to a 4.7% increase every year over those years. It's an average of those increases. Now, the problem in the most recent years is that we have COVID sitting right in here. And so this analysis of that, you just couldn't use it because it's so variable, huge downturns, huge upturns. And so you don't have a sense of what the rate of expansion of sales should be. So that the easiest thing to do is just to pick the rate of inflation, or slightly better than the rate of inflation for that expansion. So when we're done with this analysis of the adjustments down here from line 52 and some analysis of the rate of expansion, we come up here. And here are the mini cash flows that, looking out in 2024, where we're going to use that 4.7% or 4.1% expansion rate for a few years. But nobody has a crystal ball beyond 2 or 3 years, so we go back down to a rate of inflation. Okay, here's the real profit margin. Now, the sticking point for a lot of business owners is they'll say, well, but I can make way more profits. I'm just not doing it. Yes, but you haven't proven that. And a buyer will only buy what the business can do currently. They're not going to buy your projection of what the business might be. So you could have a business that has, multi-million-dollar sales in the future, but if you're only making a 2% profit margin in the present, you've got no leg to stand on with the buyer, or someone like me who's doing the value. So here we are down here with the mini profit and loss statements. There's 10,000, 9,000, and the net cash flow of 1,000, or the profit margin. Now these down here are the net cash flows in future years that you're going to have to discount backwards. And when we do that, if we discounted all of those 10 years of cash flows backwards at 2%, you would want to pay $10,533 for this business. If you discounted it backwards at 10%, like the stock market, you'd pay $7,061. And you can see that as your required rate of return over here goes up, the value of the business goes down, because you want to pay less for the business to make more over here. So in a small business that's, not too risky, you might choose 12%. And here's where the financial analysis ends and the negotiation begins. Because if you can get the buyer and the seller on the same page, and you can say, do you agree on this? Do you agree on the profit margin? Then the next step is to say, what do you believe the risk of the business is? And now you have an area in which you can negotiate a price. Over here, you can put in on my spreadsheet, if you wanted to sell half the business, you can see what half a business would be. If you want to bring in an investor and sell 10% of the business, well, you can see at a rate of 12% that you could sell the 10% of the business at 646. This is another thing that people make really bad mistakes on, and that is they go to sell the business, and they either ask for too much and there's no return to the investor, or they ask for too little and they've given away too much of their business for the wrong price. So let me go over this top to bottom again. The first step is to adjust the most recent profit and loss statement. So you get a real profit and loss statement. You find out what the actual profit margin is in the current year is 10%. You try to estimate a rate of expansion. And if it's so variable like the COVID years, you might take just the last year, or you might have to just estimate based on the rate of inflation. And then you create these mini profit and loss statements out 10 years that are created by the profit margin up here and the rate of expansion in these years, all 10 years. And then this does the work for you down here, discounting all the cash flows at like 12% to come up with the value of the business. Now that seems like it's very straightforward, but of course, to put this together and to make value judgments, you have to have done a lot of them. And I'll give you an example of this. when I was doing mergers and acquisitions for Twin Star Credit Union, they wanted to buy an auto company, like a auto dealership. Except, you know, it was a sales driven thing, and it was a private company that didn't actually own too many cars, and they had excessive because they were new. They had excessive rates of expansion, like 100% expansion for a couple of years, and they wanted to use 100% in this area. And I said, yes, we can use 100% for maybe 2 years, but then we have to go back down to the rate of inflation, because if we hadn't, it would have been worth $3 million. And when we actually did it with at the rate of inflation after a couple of years, it was worth about $500,000. So there's a little bit of art in saying, you know, what can you believe? What inputs go into the spreadsheets, and are they real? Also, when you're negotiating, it's very good to do this valuation with the buyer and the seller if they're amiable to it, because you can sort out all of these issues one at a time with both of them sitting in the same room. The buyer and the seller can question these adjustments so that the buyer in particular is ready to verify that these are the real numbers, that they can question any rate of expansion of sales, especially if they're anomalous, like very high and very low. And they can question this rate of expansion and the profit margin. And typically when you do that, the buyer who thinks their business is worth $350,000, you know, through some ad hoc method or just wishful thinking, finds out that the business is worth $250,000. And there's a lot of transformation in their thinking as they adjust to that paradigm. And they may present, you know, that their business broker said it was 3 times the net, and that's $350,000, but that is not financial theory, and it's not supported by anybody who values businesses. So there's an adjustment period usually where, even if you go through this with the buyer and seller, that the seller in particular has to adjust their expectations downward. And sometimes the buyer has to adjust their expectation upwards also. So, questions?
Hey, Douglas, I have a question.
Yes.
It sounds like you're advising against using multipliers based on the industry. You know, for instance, a manufacturing company might be able to produce more profit predictably than food service industry. Was that true? You're evaluating business by business rather than adding a multiplier for an industrial.
Yes, my answer to everybody on that, the answer is that all the value is in the profits.
Mm-hmm.
And there's no way to say that value is anything more than they can produce in profits. And then the risk rate, or the required rate of return of the buyer, they have to negotiate that down here. But if you have no profits, you have no discounted cash flow value. And the question is, here's another argument. People say, well, the name of my business is worth $1 million. Well, it might be, but that value is in the profits. If the name is worth anything, it's already represented right here in the profits.
Mm-hmm.
That's what that name is worth. The name, the assets, the ability of the management is all in that profit number.
Okay, so I just want to be clear that there isn't a multiplier and there's not any goodwill calculation in here at all. So it's more scientific and less artful.
Yes, well, I mean, if you presented any other method to any finance person, they would argue against you, saying that there's something more than value in the profits, that there's some kind of blue sky above those profits. No, whatever you're saying is of value is already represented in those profits. That's why I always suggest if I have somebody come in who wants to sell their business and they say, well, I think it's worth way more than that. And, you know, my answer is no, these are the profits. So if you're not happy with the price, let's work on your business and improve the profits so you can prove that.
Thank you.
Yeah. Any other questions?
Got a quick question. Is
Yeah.
there a difference in how you evaluate between a business that may have consistent profits over a number of years versus one where the profits are increasing?
Yeah, that's a bit of the art here. Inconsistent profits make that rate of expansion iffy, right? So what I would do if I saw inconsistent profits versus consistent profits, but you have profits in the current year, I would raise the risk rate. Like I would say here, instead of 12%, those iffy or those swings in profits, let's take account of that. Let's do the best we can up above with the many profit and loss statements, but let's charge a risk premium.
Yeah, I'm not so much talking about varying profits. I'm talking about, I have a business, and for the last 15 years, I've made $100,000. Maybe it goes up by inflation a little bit, versus a company where, I made 50,000 5 years ago, 60,000, 70,000. This year I made 100,000. Is there a difference in how you would evaluate those two businesses?
Well, here's
Are
how
you Sorry, are you asking about weighted averages or something, Jay?
One business is showing growth and the other business is showing stability.
Yeah, the thing is about growth is how far out can that growth go before it drops back to some reasonable rate? And that's a negotiation with the buyer.
Yeah,
like how far you can actually confirm that. But here's the thing about a private consulting business is, let's say that down here in this consulting business, we've got $1,000 in profit. But the question is have you paid yourself a reasonable wage, before you come to that profit? So here's an example. I had a gas station owner who wanted to sell his business, and he said, I've got $25,000 in profits a year. And I said, yes, but you haven't paid yourself. What would you pay somebody to replace you with the same skill level to make that 25,000? He said, well, probably 25,000 in wages. I said, okay, so you have no profits. If you had to pay somebody 25,000 to get that profit, you have zero profits. So it's only the liquidation value. He certainly didn't like that. But it was true that he created no excess profits beyond his draw, his reasonable draw that would represent wages of somebody that he would have to pay to replace himself. So I look at businesses as an economic investment, that if you have burdened it with all of its expenses, including personnel at reasonable rates, then you value the profits after that. You can't say that your draw is the profits. It's not. You have to have some meaningful expense for the skill that you're providing to the business.
I have a question, Douglas.
Yes.
What about businesses that own real estate?
Yeah, that's a separate calculation. So just recently what I did was there was a business for sale locally that had a building that was owned, and had the business inside of it. So we did a valuation of the business based on discounted cash flows. And then we had a real estate broker do a evaluation of just the property. And the property was valued about right, but the business was overvalued by maybe 5 times.
Yeah.
So when the purchaser made the negotiation, they said, here's the value of the building, we'll buy that for this price. Here's the value of the business, we'll buy it at that price, the other price.
Okay, thanks.
Yeah, and here's the terrible example of that is that I think this was about 30 years ago, maybe 20 years ago. A brewery on an island off in the middle of the Mississippi near Minneapolis wanted to sell their business, and they sold it for $10 million, and there was nobody questioned it. The buyer said, that's fine, we'll buy it for $10 million. And the next day they brought in tractors and knocked down the entire brewery and sold the land under it for $75 million. So there's the warning about property when it's mixed or enmeshed with a business. More questions? Well, this may be a short. Sorry, go ahead.
Sorry. Can you evaluate synergies of a buyer within the transaction price or the purchase price, i.e., if another going concern comes to buy you and can operate that by taking some of the backstage work into other areas where you're the cost of that backstage help can be synergized in that other company? Does that increase the value, or is it a non-factor?
No, because you're buying the business that exists. If you, as the buyer, want to do your own valuation and say, yeah, but look, I can lower the cost of this business and therefore get more out of it. Well, that's up to you, because that's your work and you should be paid for your work and your synergies. But those synergies don't exist in the current business, so you can't really value them. I would value the business as it is. And then if you're a buyer that has skills that can improve the business, that's your extra profit there. That's your extra return.
Great, thank you.
And you might find that I find that where some businesses, they are overvalued for what they are, but the new owner has higher levels of skill than the current owner, and they make the risk calculation that they can do better, and so they pay a premium, and they say, yes, I will buy this, at an 8% required rate of return because I know I can improve the profits dramatically and make better than that. But the owner of the business, the seller, cannot make that claim.
I guess the follow-up question to that would be related to if your business has dealerships where you're unique in a particular territory, are those valued at a higher rate, or is it still just based on profits?
Well, it's still just based on profits. I mean, you say it's in a good area, but does it actually create more profits? Is it a higher profit margin or not? Because profit margins don't lie. Again, you might be saying that's the same blue sky argument. Okay, I'm going to unshare my screen now. So that's the blue sky argument, that somehow there's value beyond the profits because I'm in a location, or I think it's worth more, or the name has more value than that, or we're an established business. And I don't buy that argument. All the value to me is in the profits. And if there are no profits, then it's only a liquidation value.
That brings up an interesting thought with regard to real estate. Because I've known a couple of businesses where the business was very successful. Owner was ready to retire, sold the business, was on a piece of property, but the property value had increased tremendously, so that the people buying it were paying, the profit was, I don't know, let's just say $1 million. But the current owner was making $1 million on something he paid, real estate he paid $100,000 for 20 years ago. And now the new owners are looking at $1 million profit, but they're going to pay $1 million for the property plus the business. So how do you work that?
Yeah, I just had one just like that, where the owner of a business who's renting, excuse me, wants to buy a building, but everyone knows that real estate prices are inflated in Port Townsend and Jefferson County in particular. And so when I did I did a value of a commercial lease, okay, first, not a value of the business, because they weren't buying a business, they were buying a building. And the question about a building as an economic entity that you're buying is how much you're going to pay for it, and will that cover the cost of the loan? Well, the rent you can charge. And the argument of the real estate investor was, well, this person's going to move their business into it. It doesn't matter. They're not going to rent it. And I said, no, it's still an economic investment. And, if they could only collect $5,000 in rent a month, but it cost them $4,000 in fees a month, that might be a 10% return. But when you say that what they can collect each month, and you use a cost of capital to determine what the building should be, like a discounted cash flow, they wanted more than $800,000 for the building, and it was really worth only $750,000. So the real estate broker, his intention is to get somebody into a building. My intention is to show them the risks of buying that particular building. And usually commercial real estate is pretty reasonable in Port Townsend, because they have cost of capital of about 6%. That would be your return on investment, basically. And but in this case, there was no return on investment because if the owner moved in and then got hit by a bus or got sick and they had to rent the building, they could not cover the cost of the loan with the rent anymore. So that's my caution to the owner is, as an economic investment, it's not worth the $800,000. It's only worth $750,000. But somebody might come in and outbid them just because they're afraid they won't get any property in Port Townsend. And
Right.
that's the problem here. In a normal market, nobody could sell a building for more than it's worth. I'll give you another example. In my private practice in Olympia, there was a building on 4th Avenue, and somebody had bought it for, I think it was $400,000, or no, $350,000, and they wanted to sell it. And I went through this with my client. I said, well, it's only worth $250,000. And when they proposed that price, the business owner blew his stack and, cursed at us and did all kinds of things. And so, my client went away. A year later, that seller came back and said, would you like to buy it for $250,000? Because nobody was going to buy it. We redid the value of the commercial building and we said, no, $225,000 is as much as we can pay for that. And they purchased it. So in a normal market where you can value a building as an economic investment, only an unsophisticated buyer is going to pay a premium on it. And then probably work under a debt burden for years and then maybe lose their shirt on the building when they sell it.
So even if you can pay cash for it, you're going to want to do this analysis to figure out what it would be on a return.
Would you like to see like that value of a commercial building? Because this is kind of related.
Yeah, sure.
So let me
Hey, Douglas, while you're doing that presentation, can you talk about a business growth strategy, perhaps where one business might be looking to use asset accrual as their strategy and another business might be focused on leasing or, having kind of a light touch with their location?
Yeah, what in my opinion is that you shouldn't buy anything that you haven't valued as an economic investment. If you're buying it for some other purpose, you may get caught flat when you can't do anything but rent the space, and then you're out of luck. Then you're underwater. So let me share my screen again. And then I will pull up, let me get rid of that. And I will pull up value. Can you see the purchase price of a commercial building?
Yes.
Yes.
Okay, so here's how I do this. Here's the maximum monthly payment. You can see that here's square footage, 4,000 feet at $1.40 a square foot. That's the maximum you can get out of it. We're going to assume 100% occupancy rate, but we have to subtract from that monthly expenses for insurance, property taxes, and so forth. That's the total. So here is the actual income per month. And if you want to make a 10% profit on that, you can only pay a loan amount of $4,709. Otherwise, you won't make any profits on it. So as a cost of capital, trying to reverse engineer this rent with a cost of capital in a 30-year term, the business is worth $707,000. But it's less renovation costs because no economic investment will produce that without some kind of investment. We're assuming no renovation costs here. So that's the value of the building, right? So this is the actual valuation for that building that was over $800,000. So what happens? Here's your risk, right? 7%, 30 years, $875,000. Your monthly payment on a loan is $5,821, but this is what you're going to collect in rent. So you can see you're underwater if you have to rent it. Now you might say, I don't care, I'm never going to rent it, I'm going to have my business in there. But if anything happens, you are underwater on that day. Now let's look at can we reduce the your required rate of return to make that purchase price make more, or to increase the purchase price? Well, at 5%, it's worth $747,000. At 1%, sorry, at 1%, it's still not worth $800,000. So,
But what you're saying is that even if I had the cash to pay for it, this is how I should think about it.
yeah, because, well, if you pay any more than 707,000 here, you will be making less than 10%. So how much less? Well, let's go down to 0.01, and it's going to say, yeah, there's 0.01. It's still not even worth $800,000 at a 1% return. And the thing is if you're going to invest in an economic investment, and you want 10%, well, you could just throw darts at the Wall Street Journal and buy the stocks under those darts, and you would do better than buying this building.
Douglas, is this based on a triple net? Say if you were to lease that particular building, what would a triple?
No, that's yeah, I know the triple net would require the renter to come up with some of the property taxes and other issues. So you'd have to calculate that in. Like in this section here, you would either add or subtract whatever the triple net is worth to come up with what your income per month might be. Yeah, and I sat with a commercial real estate broker and went through this with him, and he sure didn't like it. And I said, yeah, we have different objectives. Your objective is to get the client into the building. My objective is to make sure they don't lose their shirt. And so the business owner now is very aware of what risk they're running to pay any more than this amount, the 707,000. And that's where the EDC can do great work for local clients, is helping them with this more advanced kind of calculation, so that they do not make, terrible mistakes. I'm going to stop my share again. So any questions about that? That was kind of a nice aside, because that commercial building, the question was, what if you have a building on a piece of land and there's a business in the building? Yeah, you have to value the business separately from the land, the commercial building, and the commercial building has its own value based on its rent. Even though there might be people out there coming into town who might buy it out from underneath you because they just have cash and they don't care.
Do you ever take into account the expected increase in the value of the land?
You can do that, but that's a risky thing to do.
Sure.
Yeah, there are two. It's sort of like a bond that has interest and appreciation on it, or a stock that has dividends and appreciation. Yeah, there is a part of that there's a return on a commercial building due to the appreciation. But but are you going to rely only on the appreciation? And in the current time frame, are you underwater if you have to rent it? So if you're relying only on long-term appreciation, what you're saying is, I have to sell this building to make a profit.
Yeah.
Yeah, and I've had people make every mistake you can make and fall into every positive mistake and make way more than they thought they were going to make. But it was because there were two unsophisticated people. The buyer and the seller were unsophisticated. They came to a price that really hurt one of them and benefited the other.
So if you were going to sell a business, Douglas, and you did own the real estate, is it best to then negotiate a sale of the business separate so that you can make sure the new business owner can be successful before negotiating the sale of the real estate with it?
Yeah, well, that's your choice. It's like, what investments do you want to have? I've had plenty of businesses that sold the business and kept the real estate and rented it. And that was their passive income in retirement, was renting that building. Some did not want the hassle of being a landlord, and so they sold the business and they sold the ground under it. The problem is can that business operate? If you sell that property, can that business operate on that piece of property anymore? Like the land might have appreciated so much that you can sell it for an amount that business can't, it can't be run profitably on that land.
And that would be the question. Then would it be best to move the business to a more affordable piece of land, then sell the real estate separately out from under that?
Could be, yes, it could be. But that's all, there's a big expense. There's an outlay of cash to move everything.
Yeah, there is. Unless somebody's willing to pay to move you.
Yeah.
But even with that, if you're a retail type establishment, the location where you're at is worth something as opposed to having to move somewhere else.
Right. Yeah. And that happens all the time in cities. And you saw that, well, you saw it in two ways back in the 50s and 60s, where as inner cities devolved, people moved their businesses naturally to locations that their clients preferred out into the suburbs. And they bought cheap land out in the suburbs, moved their business there, and did better than the expensive taxable land close to the downtown core. But then the taxable land in the downtown core lost huge amounts of value. So the question is, where did you take your risk? Did you take your risk in the move to the suburbs, or did you take your risk by staying downtown and having your property devalued? That's the Detroit to it. I grew up in Detroit, and there are some places in Detroit where I used to ride my bike where there aren't any houses anymore. It's an urban forest because they tear down the vacant houses.
Yeah. So Douglas, I don't know if you can see Cindy has her hand up.
Oh, hi, Cindy. Yeah.
Oh, hey, Douglas.
Yeah.
I was just hoping you could, before we end the call, talk about what people might need to prepare ahead of time if they're seeking a valuation.
Yeah. Well, you want to get your accounting in order so that you can prove to your buyer that your accounting verifies and matches your tax returns. If you have really messed up accounting, then they can only rely on your tax returns. Whereas if they could look into your accounting, they could actually do a financial analysis, a deeper financial analysis to make themselves feel comfortable about it. But I think, so that's one step. The other step is, have you maximized your profits in the current time frame so that you've got a good case to make for a higher price? And I've had both ways where people said, oh, well, I shouldn't sell now. And they got busy and they doubled the price of their business in a couple of years. I've had others who say, I don't want to do that. I don't want to work that hard. And I say, yeah, but your profit margin is so low that your business isn't worth anything. Well, I think it's worth $1 million. Well, I have to be kind and say as kindly as I can, no, it's not. Some people will believe it and some won't. Some will work hard to improve their profits and others are not interested.
Okay, so tax returns are the primary thing that people need to have prepared, as well as their financial statements.
That's right. Yeah.
Okay.
And again, I'd like to do this in a collaborative framework. I don't just take numbers and then do valuations for people. I want the seller to be in here with me, verifying the cash flows as we adjust them. And then sometimes even I've done this with both the buyer and the seller, sitting with the accounting system, verifying the numbers going into the spreadsheet. And by the time we were done with the analysis, they had agreed on a price because they had been in the process.
Yeah, that's so nice. I've been in a few negotiations that were really painful because the owner really had a rosy picture of their value, and you could just see it wasn't going to pencil, and the buyer wouldn't be able to get a loan for that amount for that property.
Yeah.
And I'm wondering, I mean, it's so easy for us to be attached to what we've built. And I'm wondering about your approach to kind of having this reality conversation and helping people understand how to value showing that profit long enough ahead where a sale is actually possible.
Yeah. I mean, first I tell them that it's going to take 3 times explaining discounted cash flow for them to get it. And they're normal if it takes 3 times. And then if I take them through it, you can see the pain accruing on their face as they find out that it's not worth that much. And, there's a sort of like death and dying approach to it. There's denial, there's anger, and there's acceptance. And when they see that value isn't what they want, well, of course, you offer them counseling and you offer them a solution path for improving their profits, and you show them what would happen if they could double their profit margin in a year. Well, how does that work through the spreadsheet for discounted cash flow? And it can be dramatically higher in value. Okay, so any other questions? I think we're drawing to a close here, and I thank everybody for showing up, but any final questions?
I was just thinking of when we advise beginning clients or people who've already bought the business and they come in about this idea of begin with the end in mind. If you point people in directions like that, because this analysis that you're doing can begin with the end in mind. So somebody has a 5-year run up to dive off the diving board of selling their business. When you have 5 years to work on it, then you can come to you, Douglas, and figure out exactly what you need to do to make it sell for the highest price, and therefore enjoy the most comfortable retirement you can think.
But also knowing what their goals are. Like I have many clients who their goal is to make enough money to just live in Port Townsend and be happy and have plenty of time off. That's their goal. It's not to sell the business at the end, it's not to make millions of dollars. So I help them do that. But I try to make it the most efficient way to make profits so that they get the profits they need and the time off that they want.
And the time off, yeah. Nice. Thank you.
Yeah, you're welcome. Okay, if that's all, then we'll close the meeting. I thank everybody for coming, and we'll have another Business Resource Roundtable next month.